Good afternoon, everyone, and welcome to Stock Market Today. Ali Corman, Ed Carson here with a look at the action in not only today's session, but the week as well, and a look ahead to perhaps what we could expect next week. And Ed, it was pretty bad out there today. Maybe a touch of relief at the end of the day, but not much.
Yeah, I'm not going to get too excited about a 15-minute rally, even if it is at the end of the day. But, I definitely want to take a look at a few things. Look at DocuSign, look at Adobe, and look at Tesla and some of the lessons we can learn from those.
Yes, software not looking too good right now. We'll dig into that. But first, let's take a look at the Nasdaq Composite here on Think or Swim from TD Ameritrade, finishing the day down about 1.9%. We also had the S&P 500 down 1.8% for the day. The Russell 2000, the hardest hit, down about 2.3%, and the Dow down just 0.2% for the day, but a big engulfing bar today, Ed, right around that 50-day line with not a great close.
Yeah, and I think we can just almost start even a couple of weeks back, just from where we peaked. We reversed, pretty sharply that day. And ever since then, we've had these, every once in a while, we have a one-day rally, and they don't last. They don't last. And I think that happened again. Twice this week, we had rallies. We rallied on Monday. We rallied on Thursday. But it was a very negative tone throughout, bouncing back a little bit. But ultimately, but it just can't last. It just doesn't. It's like a team on a losing streak that ends up 3-13 for the year. Yeah, they win every once in a while, but it's still a losing team. And right now, the market's been losing. Especially on the Nasdaq, especially on the small caps, but man, a lot of damage. And in many ways, the indexes aren't showing how weak it is with, some of the small caps, advanced decline, and some of the breakdowns we've seen.
Yeah, which we will get into, but definitely the short-term trend, not healthy right now. So when conditions are like this, we don't want to be swimming against the tide.
Yeah, you really can't do it. It's like, look, if you can make a lot of money in a good market, that should be enough. You don't need to make money, try to make money in every kind of market. And this is just so hard to do so. Most stocks are going to fall in this environment. And if you buy whenever we have an uptick, when the trend in the short run is weak, there's a very good chance it's just going to roll right over that, almost that minute or the next day. And it's just really, really hard to make money, especially with new buys.
And not only have we not seen any follow-up to those isolated days that we attempted to rally, but those rallies, as we were talking about on IBD Live, came in weak volume as well, which is an especially negative sign. So until we see some more substantial signals of a change in the tone, it seems like reducing exposure, or at the very least, very least, not making new buys, but probably reducing exposure here, going to cash is definitely what you want to be doing.
Yeah, I mean, even if you weren't thinking about your portfolio, just getting rid of losers, cutting winners that are round tripping, that alone should be reducing your exposure, especially if you're not making new buys. And so maybe holding on to a few longer term winners, but that's about it, I would say.
Okay, well, let's also put this in perspective by taking a look at a weekly chart here. So we now have two big red bars in a row. And the last time that we had that, it looks like was going back to March.
Yeah,
of this year.
Definitely a big change in character. I mean, we had a couple of sort of back and forth weeks before that, but boy, we had a couple nice stretch there. I mean, see, that's what you want to be playing in. That's where the money's to be made. There's not much money to be made when the market is going that way.
Okay, well, we'll definitely keep that in mind when we take a look at all of these other charts as well, Ed. So here is a look at the S&P 500. So the S&P, as I mentioned, closing down about 0.8% for the day. So just above that 4,500 level, but below the 50-day line for sure, even with the attempted mini bounce into the close.
Yeah, I mean, techs are getting hard hit. Financials didn't have a great time. I think energy held up reasonably well, but that's after tumbling last Friday on all the on oil prices coming down. So there's just not a lot of strength out there. I mean, this is holding up better than the Nasdaq, but that's not saying much.
And just a quick look at the Dow here, not as hard hit today, but coming all the way down to its 200-day line and testing support there. So we'll keep an eye on the 200-day and that 34,000 level. Small caps, which have seen a lot of pain and suffering even before the last week and a half or so, still getting hit pretty hard this week. So after a big haircut last couple of weeks, down 4.2% last week, adding on another 3.7% decline this week. So this definitely is standing out in a very bad way in the small cap land.
Yeah, I mean, it's obviously not had a good stretch, like basically the last 8 or 9 months. But the last few weeks have just been really, really poor. And it was so disappointing because they were finally taking off. It looked like it was finally really joining the rally. And that sell-off was a really early sign that things weren't going well, and it's not getting any better.
Okay, well, let's take a look at how growth stocks fared for the week. This also is not encouraging to see FFTY down over 6% for the week after a loss of about 6% last week.
Yeah.
So 2 back-to-back bad showings.
Really bad showings. And it's just, it's just been really, really rough out there. It had a really strong streak again, sort of like the small caps a few weeks ago. And then, but everything has been going really, it's a sea of red out there with a lot of growth names. And that's why if your portfolio is looking worse than the indexes, or why isn't it holding up like Apple? Well, Apple's doing Apple. This is the rest of it.
Yeah, and within growth, software in particular, taking it on the chin. So here is the IGV tech software ETF. What a plunge for this area. So down about 7% for the week, taking a trip all the way down to its 200-day line.
And you could argue this could even be worse if it weren't for something like Microsoft that had held up reasonably well. But this week we had CRM and we had Adobe sort of break down, and we'll get to Adobe, but it's like those kind of things along with all those high flyers that have had just complete meltdowns. This sector is just really broken right now.
And, we also talked about breadth, and let's go on over to GMIAB on MarketSmith. So here is the Nasdaq advanced decline line. So breadth has really been struggling over the last couple of weeks, not just the last 2 weeks, but the last 3+ weeks. Arguably, we were trying when we saw the follow through day in mid-October. Those next couple of weeks, we did see an improvement, but that got wiped away and then some in the last couple of weeks.
Yeah, and this is only through Thursday, so it's going to be back to the recent lows. After today, it was a really bad day for the advanced decline. Yeah, and it never got all to those highs. It's been weakening for several months, and that was been a bad sign. Those mega caps leading the way. Yeah, this is a really negative sign.
Okay, well, wish we could be a little bit more positive here, but I guess the positivity hopefully is that what we've been talking about in terms of the seismic shifts underneath the surface that we've seen all year, warranting looking at those early entries, taking some profits into strength, and managing trades with position sizing and those sell signals as well to hopefully help you weather some of the shifting market conditions like we've seen over the last couple of weeks. But now let's turn our attention to DocuSign, which had a nice run in June and part of July. But is this indicative of this destruction is pretty staggering that we're seeing for growth stocks like DocuSign? It's
amazing some of the losses we've seen in some of these software names. Obviously the multiples have been extremely high. Look at this. The multiple is still 126 and the stock has lost, I don't know, it's like 60% and lost 43% or so today. Just an amazing drop. I mean, the growth is great, but when the tide turns against these highly valued stocks, it can turn so fast. But there were lots of signals along the way. It wasn't like, oh, it's only today that you should have known, like there was a sell signal. Obviously today was catastrophic, but yeah, there was, even if you bought, if you bought it near the high or you bought an early entry in June, there were places along the way that sell off after that prior earnings report. It's first gapped up and then immediately came back down and kept on selling for several days, tumbling through the 50-day line. And, really, anybody who bought high up should have been getting out at that point. And even people who bought on the, the early entries, say around, so around there, probably wanted to be loosening up. It did rebound in October off the 200-day line after nearly basically round tripping, but that was a short-lived thing. And so if you still hung on, it started breaking the 50-day line multiple times, clearly showing that. Then it broke the 200-day line a couple weeks ago. All these things is like, okay, at that point, it's round tripped. Everything is breaking. Software looks terrible. Earnings are coming up. There's no reason to be in this stock. And so, some stocks rose. There's a few stocks that have rallied off of, earnings and that kind of thing, but a lot of them have tumbled, and the holding on to it like this, this is surprising how bad it was, but at the same time, it's not a shock in a way. It's like, this is just something why you have to take this into account and manage it. And just because you like the story, just because the fundamentals look good on paper right there, the technicals are usually going to draw you out before the fundamentals.
That's exactly right. And even long-term leaders like Adobe, not immune to the downdraft. So Adobe down about 8% on Friday after an attempted breakout from a cup with handle base not all too long ago. But today marks a pretty clear sell signal, at least for recent buyers.
Yeah, and it wasn't the greatest looking sort of V-shaped base. And then the breakout was sort of choppy. It's sort of fighting to it. But, the relative strength line kept on trending higher from the breakout. So it was doing reasonably well, even as of yesterday. But you just have to know, it's just sort of going, it's like leaders can do this. Sometimes there'll be stocks that hang on, and then they don't. And so as the market continues to weaken, you have to recognize that there can be those breaks and this happens again and again. Now, there's still a few stocks that are hanging on. Some are weakening, some are holding pretty strong, but most are doing things like this. They hang on and then they break. And so if the market continues to weaken, that's going to happen pretty much to every one of them.
And not only do we have Adobe down 6% from this traditional buy point, but a big slice below that 50-day line. On a weekly basis, Adobe finished, let's say, about 3% below the 10-week line as well. And let's also talk about, handling this from a long-term leader perspective as well. So, recent buys is one thing, but what about for handling this as a long-term leader?
That's a little trickier. If you bought it, earlier back in May, or if you bought it even longer, it broke through the 10-week line, though it's still above the base. And I suppose if we go to a monthly, we can take a look and see how the relative strength line is holding up. The relative strength line doesn't look too bad. That's partly a reflection of the market. Let's face it, the market sort of stinks right now. So a lot of things are selling off. If you have a long-term gain in this, you can wait till maybe you really break that trend line, really show real decisive weakness. The whole idea of a long-term winner is that you would try to hold it through corrections if you have a big gain. So I think you could still hold it from that perspective. From a position trade, there's a lot of reasons to sell it. Obviously, if you bought it recently, you should have been probably lightening up anyway before today and definitely gotten out. But the long-term leader, it's a different perspective.
And we do have earnings coming up from Adobe. It looks like in a couple of weeks. Not sure if it will set up a new entry between now and then, but did just want to mention that we do have earnings coming up. And now let's talk about Tesla, suffering a loss of about 6.4% today. Not a great week So below its 21-day line, an area that it's tried to keep above. But not only can stocks test key support levels that are moving averages, but also price levels. And it seems like this 1,000 level is one of those price levels to watch.
Yeah, it is. And, let's face it, look, this is holding up in many ways better than a lot of other stocks, including a slew of other EV makers. So it's just sort of like this is starting to bend. You could say it's bending like this at NVIDIA. Yeah, it seems to be finding its support at 1,000. It's done that sort of before. The 50-day line and the 10-week line basically line up with that. You have this area. I mean, you could almost imagine a dream scenario where Tesla undercuts the 50-day and the 10-week line and undercuts those prior lows just a little bit, sort of creates that double bottom kind of feel, even whether or not it ends up being a double bottom, and then rebounds. I think in this market, you want to be just waiting for it to actually show real strength and, break above some kind of trend line above that, or at least a trend line from the top kind of thing. But yeah, I mean, this isn't a key area for it. And again, you can be a relative winner and an absolute loser in a correction or a troubled market. And so if this market continues to weaken, high growth names like Tesla are probably going to come under more pressure. And so even if Tesla is one of the better ones, and it could well be, but this one or NVIDIA or even something like Apple, they might really start to come under pressure going forward. So that's just the kind of thing. I think this is a key area. This might be where it really finds support, and that'd be great for Tesla. It'd be good sign for the market, but definitely want to watch it, see if it can hold these areas.
Yes, watching it is something we are all definitely doing it, whether we like the stock or the company or not. Isn't that right, Ed? It's the one we got to watch.
We got to watch. And, I'm trying to look at this technically. It's not terrible. It certainly looks a lot better than a lot of other stocks, but this is also why people trying to play it. Oh, I want to play these little bounces with this stock or any other. Those things just aren't working. Those things aren't working. You could be sitting on a big loss, even though the stock is doing reasonably well. And that's just something you don't want to be doing, sitting in a market that isn't going well.
Yeah, got to be careful about that. Okay, so limiting exposure at this point seems definitely warranted. But let's talk about some other strategies that investors should think about at this time. If they did suffer losses in their portfolios this week, what should the mindset be?
Well, the mindset, you just have to you have to put that behind you. I mean, and part of it is like, if the trades haven't worked well, just get it out there. I mean, I've noticed sometimes it's like when I hold on to stocks, that's when I'm going, that's when the nervousness, once I sell it and get rid of it, okay, it's done. It's done. It's a sunk cost, and just move on and just try to resolve to be better. Look at the trade. We'll see how you could have done that better. And instead of bemoaning, a mistake or just bad luck, I mean, if a stock gap down, work on those watch lists and really develop that. See, focus on making money in a good market rather than trying to avoid loss, rather than fighting a bad market. I mean, that's really what you want to be doing. Playing when it's sunny out, and staying inside when it's raining.
Yeah, and we don't know exactly when it will be sunny again, but if you think about the follow-through day on October 14th, and even a couple of days before that, we started seeing some interesting looking setups. And then on the follow-through day, and after that, those next couple of weeks, that was a really great period to be investing. So it really paid off in that last downdraft to have that watch list ready, because that best window of opportunity was really a couple of days that were the absolute best days to be getting in on some of those early entries. Of course, there were later entries that had worked as well, but that's something to think about with setting up those watch lists.
Yeah, and don't try to buy on the first day. Like on whatever the first day is. Like if we rally on Monday, I would just try caution in general, because we've had those days. On the mid-October, we'd rallied for a little while. It was sort of a strange, some strange nature of it, but then it went. There was opportunities then. So once there's a clear signal, then you want to jump on it. So don't be late, but don't try to be too early.
All right. Any other words of wisdom for the audience, Ed, as we head into the weekend?
I think I've had enough words of wisdom and other words so far today. So
Yeah, I think I've spoken with you enough today. We can go now. All right. Thank you so much, Ed, for all your insights as always, and for everyone for tuning in. We will, of course, be back with more on Monday morning on IBD Live. So we hope you join us for all the latest, investors.com/IBD Live. And of course, we'll be back on Monday after the close as well. We'll see you then.